And have a listen to this. Have a listen to this.
Interest rates are higher. I know people don't like that, but you should be welcoming a stronger economy.
And maybe a deal has a point about the machinery of capitalism being oiled with the blood of the worker.
The United States is a country that has always paid all of its bills.
Lannister always pays his debts.
Don't let the bastards get you.
Hello and welcome to Comedian versus Economist, our first for 2023. We demystify the world of money and help you get a handle on the bigger picture. My name's Adam and we're joined as always by my little older brother and real life economist, Thomas. Hi, Thomas.
Yeah, g'day Adam, how you going?
I'm doing very well, thank you. Happy New Year.
Oh, and to you.
I've been busy. I learned a lot over the break. I've been researching. Turns out that with my fry pan set on a medium heat, it takes the exact same time to fry an egg as it takes my toaster to perfectly cook my toast. So, 2023 looking pretty good right now. Hey, new year, new intro music. What did you think? Did you pick all the voices? Yeah, tell us what you think. Even better, tell you what, first person to send us an email correctly naming all the voices will, win a hat. It won't be a CVE hat. We don't have any merch, but it'll be a hat of some kind. So if you can correctly identify all of the voices in the new intro and send us an email, cve@equitymates.com or via the website equitymates.com/CVE, you will win a hat. To be determined. I'll have to see what hats I've got. Have you got any hats, Thomas? You don't look like a hat. You're not a hat guy.
No, I got too much hair for hats, really. Yeah.
It's a problem.
But I do like to be sun smart. So.
I saw your hat. You'd cut the center of it out. It's like, It's a ring. It's like you're wearing a donut on your head instead of a hat. Hey, shout out to Alex, George, Arkash and DW for sending us messages too during the break saying, when are you guys coming back? Nice to be missed. So thank you for those messages. But Thomas, massive show coming up. We're going to find out what's up with the housing market, not prices, that's for sure. We'll see what your prospects are for buying a house look like in 2023. Little fun fact, everyone's using ChatGPT at the moment, right? And I asked ChatGPT for a housing market pun, and it gave me, the housing market is on the rise. It's finally starting to roof again. So I'm not sure puns are ChatGPT's strong point. We've got some population data out of China. My understanding is there's still heaps of people there. We'll see if we can perhaps uncover some more nuance in the data. And could 2023 be the year of mega threats? I sure hope so. Remember the 90s anti-terrorism ad, be alert but not alarmed? Pretty hard to not be alarmed when you're hearing about mega threats. So we'll see what they are and if they're as scary as they sound. But Thomas, 9 reasons for optimism from Dr. Shane Oliver. Perhaps he didn't get the memo on mega threats. Let's start there. Let's start with some positivity for the new year, a bit of optimism. What are we looking at here?
Yeah, so Shane Oliver from AMP, he's been around for ages, one of the most well-known and best economists in the country. He sort of wrote a report at the start of the year just outlining what he thought was going to happen, but he had the 9... He did outline some risks, but overall he was pretty optimistic about the prospects for things. He gave us 9 reasons. So I thought that's a good way to just get our feet in 2023 and see where we're at. So number 1 is that long-term inflation expectations remain low. So thinking about inflation's high, came in a bit higher December quarter, surprise to the upside. So there's a little bit of a shock there. But kind of the key thing is that you don't want to happen is for inflation expectations to get anchored in. Because once people start expecting inflation, then that feeds into their decisions, and that kind of becomes a bit of a self-fulfilling prophecy. And so we have these measures of expectations. So they just ask people, what do you think inflation is going to be next year, the year after? Even though inflation's been quite high, inflation expectations haven't really ratcheted up.
Right. Why not? Denial?
Maybe denial, maybe an inability to understand basic economic concepts.
I'm going to go with denial.
Maybe people aren't listening to enough popular economics podcasts.
I read the article you sent. It said investors are now bombarded with irrelevant, low quality and conflicting information, which confuses and adds to the uncertainty. Well, that's not the best review we've ever had.
No, I mean, I think we've had 1 year of quite high inflation, and it sort of follows about 20 years of really low inflation. And so I think people are just discounting 1 year. It's like, well, inflation's been low my entire adult life. I'm not going to just shift expectations just on the back of 1 year's worth of data.
They might also be thinking it's transitory.
They could, yes.
They might be like on the transitory side still, because they listened to what people said 6 months ago.
Yeah. Well, and there is, and this comes into Oliver's second point, is that he reckons inflation has likely peaked.
Right.
We did get some services inflation in the December quarter in the latest read, but still largely a good story. So it's still largely a supply bottlenecks story. AMP published their pipeline inflation indicator, which mashes together energy, agricultural commodities, semiconductor prices, shipping rates, and some other things. Yeah. I realize I'm bombarding you with irrelevant...
irrelevant, low quality.
Yeah, so they have a pipeline indicator which does track headline inflation well and tends to lead it by a couple of quarters, and that's coming off pretty quickly, heading back towards zero even. So
this is good news, right? Inflation's coming down?
Yeah, you'd say that. Like no one likes inflation.
No.
Too much. So that's good news, and that means that people's inflation expectations are probably right, that they're not ratcheting them up. The other point, which comes into Oliver's point 3, is that he reckons the major central banks are close to done. So we might get another hike or two out of most of them, but we're pretty much done.
I feel like he's stretched 1 point across 3 points. He's going for like a power number with 9.
Yeah.
So he decided to break up 0.1 into three points.
Yeah. Well, you can't bombard people with two points. Doesn't feel like a bombardment if it's just 2.
That's what people want. They don't want to be bombarded. They want.
So I mean, they're all related, but that's the reality that he's pointing to. And I think he's probably right. I think we'll definitely get one more out of the RBA in February. March is maybe 50-50 at this stage, would be my guess.
Right.
So, out of the RBA. And a few of the big central banks went pause, like Japan, I think, just decided not to hike rates at the last meeting, and that was a bit of a surprise. And there's a few doing that.
I feel like they may be like trying too hard if they're thinking about like just manage the money, right? Like manage the interest rates, manage inflation. Don't try and manage people's expectations as well. Like you're kind of going, well, we need to control what people, like how people are thinking about it, and like it seems like misdirected effort maybe to be trying to do that. Yeah. Like people just think what they'll think, won't they?
I mean, that's one. It definitely feeds into it. It's part of the reality. I mean, the whole reason we have independent central banks, that we gave them statutory independence, was to try to anchor expectations, so that people could trust monetary policy, could trust that it was going to do the right thing at the right time, wasn't going to have political interference, and then because you could trust that, you could anchor your inflation expectations around the target, that 2-3% target or whatever each central bank's working with. That was the whole idea of having that, was to anchor people's expectations. Because if you can do that, then the rest is easy. You almost don't need to do anything more than that. And you don't need to mess with interest rates, because once you mess with interest rates, it does have these other consequences, like when you cut them to the floor, that jacks up asset prices. When you raise them, that sort of increases borrowing costs for firms. So ideally you don't want to mess with interest rates too much, and if you can just anchor expectations, and that gives you a bit of a free kick. That's
probably also why most other governors didn't predict interest rates in 3 years' time. Like when Phil Lowe said there won't be any interest rate rises till 2024, he kind of diversion from the managing expectations playbook. Anyway, I digress. What's point 4?
Point 4, China's reopening.
Oh, yeah. It's
So
different.
that
Good.
Yeah, because of the low interest rates and the inflationary expectations. Yeah, right. No, China's moving away from zero COVID, so they're not locking down their economy anymore, and then that should, it's one of the key pistons of the global economy, so that should help things out.
Last I checked, they'd moved from zero COVID to max COVID.
Max COVID.
But it's just part of the reopening. I get it, but yeah, it sounds like. And I think because we just had Chinese New Year as well, Lunar New Year, and they're saying that maybe there's going to be an explosion of COVID as a result, but only one way is through it. So, all right, point 5.
Point 5, the US dollar looks like it's peaked against emerging economies. So the resurgent US dollar in the second half of last year was creating a lot of headaches for emerging economies. We talked about this with Sri Lanka and Turkey a bit last year. Yeah, because their debt's denominated in US dollars, that creates some headaches, but it looks like it's peaked. It looks like those debt crises are kind of stabilizing. So maybe we're okay on that front. Well, it's not going to get any worse. So that's why he's listing that one.
Okay.
Number 6 is he reckons the worst of COVID is behind us in Australia. And that seems like
Again. We're out of the woods again.
Yeah.
Just hope we don't run into any more woods. Well, you don't know though, do you? I mean,
no. But I think it's probably
it does feel that way. Definitely,
it does feel that way, and that'd have to be a central scenario. It'd be surprising to get a resurgent COVID, but never know. Could get another variant. Number 7 is we should avoid recession. We should keep the unemployment rate low.
Right. I thought he was giving advice. You should avoid recession. Okay.
My professional advice.
Not financial advice. Avoid recessions.
4 out of 5 economists recommend. Number 8 is that the geopolitics might not be as threatening as it was. The strongman authoritarians are on the nose a bit. So, democracy's going to get a bit more back in favour. And the war in Ukraine feels like it's still a tragedy, but it's not so unpredictable.
Right.
So that less uncertainty is a good thing. And then number 9 is that we're in a US midterm election year. And there's this weird thing where US...
That was last year.
Yeah. Oh, sorry. We're in a post-US midterm election year.
Low quality, conflicting information.
but lots of it. But there's this weird thing where the middle years of a presidency, the US share market consistently outperforms the shoulder years of a US presidency.
Right.
Yeah. There's no economic reason for it. So it's sort of people talk about it in the markets. I mean, it's a bit weird, but it just tends to play out that way.
Like the Santa rally.
Yeah, a bit like that. No good reason for it, but it just tends to happen.
Yeah, or not happen as the case was last Christmas.
Yeah. But given 2022 was, a bear market for most of it, that sets us up for, potentially a good year in the US market, and where the US market goes, the Aussie should follow. So that's reason to be optimistic.
Terrific. And how are you feeling? Are you feeling optimistic, or are you?
Yeah, I am. I think. I've been reading a little too much about the AI apocalypse, the potential of that, potential collapse of the ecosystem. Bit like whatever.
Oh, it's a nice segue to mega threats, though.
Yeah.
All right, Thomas. We've had the good news. Give me the bad news. Give it to me straight. I can take it.
Yes. Yeah. Well. Yeah, there's a lot of bears out there that you could go to, but I think our go-to bear is Dr. Doom.
He's back.
He's back.
We talked about him early in the podcast, like maybe, must be like maybe only 10 episodes in or something, I reckon Dr. Doom first arrived.
Yeah. Yeah, he gets a lot of press because he's like just a notorious bear. Yeah, Norio Rubini is the professor at somewhere some Stern Business School or something like that. He's just written a book, Mega Threats, 10 Dangerous Trends That Imperil Our Future and How to Survive Them.
Some book.
Yeah.
Have you read it? You haven't read it?
No.
You going to read it?
Nah, I haven't got time for that.
I probably won't.
I read a blog about it.
Oh, yeah?
Yeah. Get ready for some low quality data.
Okay. So what do we got?
Yeah. So number one, he reckons that low inflation has now given way to high inflation, and that's getting entrenched, that's not going anywhere.
So hang on. So he's saying inflation's here to stay.
Yeah.
But the other guy was, Dr. Shane Oliver was saying it's going to come down. Like it's already peaked.
Yes. Yep. Yeah. I know. Yeah. And this could happen like, You could double peak. You could get a double peak in the stagflationary 70s. You had this in Australia. Inflation peaked and then started to come off, and central banks took it easy a bit, and then it bounced back, and you had a double peak. But yeah, so he reckons it's sort of a bit more structural, and that it's not going away anytime soon.
Right. Okay.
Yeah. Number two is we're looking at secular stagnation. So. Yeah, so we're going to looking at a period of perpetually low growth owing to weak aggregate demand.
Okay.
That weak demand, and like the idea here is like we've just built everything we need to build, and consumers have consumed everything they need to consume, and going forward, we just need less stuff as households, as society. And, so in the post-war years, 60s and 70s, there was a lot to build. We had to rebuild infrastructure, and there's new stuff to build. We're sort of past that, and there's sort of like talk about this stagnation. There's just not as much stuff that needs to happen, which is why inflation's come down and interest rates have come down, because there's actually a surplus of money that people just don't need to invest so much. That's one of the ideas. But he's saying, and that's because we've got inflation in that story, then we're looking at stagflation. And so we're looking at an extended period of stagflation.
But I mean, I always find things to buy. Like I bought a new TV over the break because my old one needed to be replaced.
Yeah.
So, and I needed QD OLED. so yeah.
Yeah. But did you sell on your old one?
No, I put it outside.
Oh, okay. Did you sell the one that was outside?
I gave it to a friend.
Oh, okay. Right. So he didn't need to buy one.
No, that's true. He does if he wants sound though, because the sound didn't work.
Oh,
that was the start of the House of Cards of the new TV purchase in the lounge room.
Right.
So anyway, I feel like we're
bombarding people.
I feel like we're maybe not hitting the exact mark where Nouriel Roubini was thinking.
Yeah. Well, number three is a glut of televisions.
We've reached peak television.
Peak television. Yeah. Now, number three is rising interest rates, and he reckons that risks sparking a debt crisis. Is that we're so leveraged now that we're very sensitive to lifting interest rates, and if we have to fight this, stagflation with higher interest rates, that risks triggering a debt crisis. And we could have a potential like this cascading debt crisis, saying that's a real fear. Like I think we talked about this with the UK bond market. Like if the UK bond market went over, there's so many sectors of the global economy that are exposed to that it risks cascading and bringing down everything. And he reckons that rising interest rates are a much scarier prospect than people are factoring in.
But that's kind of predicated on inflation staying high. Like banks will keep raising interest rates if inflation stays high, which he's relying. Like he's saying, that's going to happen. Yeah. But the other guy was like, nah, that'll come off, and then therefore interest rates will come down. So they're kind of a bit like cumulative, aren't they? Like they're sort of snowballed together. So it's easy to kind of make a prediction of rising interest rates if you're also saying that inflation's going to stay high.
Yeah. I mean, but this is the game, right? This is what economists are trying to do. They're trying to paint a consistent story.
Right.
Like you couldn't go out and say, I see inflation remaining low, but central banks are going to jack up interest rates. What? Doesn't make sense.
Yeah, I guess.
Yeah. So he's just breaking down his picture, helping us see it. Yeah, like he does not agree with Shane Oliver.
Yeah, fair enough.
Yeah. Point four is that the age of hyperglobalization is giving way to deglobalization. So we're moving towards protectionism, reshoring, friendshoring.
Oh, yeah. We talked about that last year too.
Yep. Moving away from just-in-time supply chains. He's saying all of that it slows down trade, but it's also inflationary because all of the cost benefits that came with globalization are going to be reversed.
Right.
So it feeds into our inflation story.
Right. So as companies move their manufacturing to more expensive places, that's going to create inflation because they've got to put their prices up.
Yeah, exactly. Number 5 is he's more worried about geopolitical threats, reckons there's more risks of cold and hot wars breaking out and more fracturing of the global economy.
Right.
Yeah, I don't know where you stand on that one.
Who, me?
No, I don't care what you think about that.
I've got some pretty strong views if you got time.
Yeah, tell us about the balkanising of the global economy, Adam.
Oh, man. I think once you start balkanising anything, it never ends well.
That's right. Yeah. Number 6 is that climate change is ramping up. The impacts are becoming more severe at a much faster pace than had been factored in. I think that's probably right. I probably agree with him on that one. I think look at the floods in New Zealand. It's a bit of a shock. Just count how many kind of extreme events we've had in the past 12, 18 months. It's kind of insane.
Auckland got half of London's annual rainfall in 24 hours.
Wow.
Yeah, ridiculous.
Wow.
London, not exactly, small fry when it comes to rain.
Yeah.
It's kind of a specialist. Yeah.
It's frustrating because, people have been predicting this for 20 years. It's finally here. Okay, number 7, he reckons that pandemics are becoming more frequent, virulent and costly. Again, not my area of expertise, but, maybe you make that case.
We've had one.
Yeah.
Not sure. Yeah. I guess if we have another one, that becomes pretty frequent. But if we don't, frequency is probably not the word I'd use to describe.
Yeah, you need
pandemics.
At least 3 data points to establish frequency, don't you? But 1920s, Spanish flu.
Yeah.
COVID.
We had bird flu.
Oh, yes.
We had some little mini ones, didn't we? That we got on top of.
Would you call them a pandemic? I don't know if you call them a pandemic.
No, I don't know. I don't know the definition. What is there? Pandemic, epidemic,
paramedic,
systemic. There's lots of emics.
Yes.
Djokovic. Most recent one that comes to mind.
Yes. All right. Yeah. So number 8, moving right along. Number 8 is that artificial intelligence is going to just wipe out a whole bunch of jobs, and that's going to create a lot more inequality. This is something I do worry about myself. I spent the first half of summer quite excited about AI, and then the more I look at it, the more concerned I am about where we're heading with it.
I did work out that through AI, we could reproduce this podcast without us being involved at all. We can have ChatGPT write us a script, and then there's a new AI which has not been released yet, which is able to reproduce anybody's voice with, I think, based on something stupid like 6 seconds of audio of that person.
Wow.
So we could literally have ChatGPT write a podcast script and then automatically make an API call to this voice generator, and it could be you and me having a conversation. We'll get some artwork knocked together by DALL-E or whatever it is, and we pretty much take this year off, I reckon, Thomas, if you want. Early days, very early days.
It is, and there's only going to be a lot of good. There's a lot of bad, but what I've been looking at, I'm just like, wow, and it's just so quick. This is where I think where we are going to be in 5 years. I think it'll destroy jobs more quickly than it will create jobs. That's the fear. I mean, I don't know, and it's a bit hard to sort of balance it all out. But
I would think our parents had the same fear about computers, though, personal computers would have been similar kind of vibes. Job losses.
I don't think so. I mean, But I think that's the thing. Like we've got the introduction of computers as a benchmark for speed, and I think AI is going to like ramp up exponentially faster than computers did. And we know that computers created a lot of disruption. It created a lot of unemployment, also created a lot of jobs. But it was at a time scale that was, I feel like, much more manageable.
Right. You reckon this will just be quicker?
I reckon it'll be quicker. And I think that just gives us less time to adapt. You know, like someone who got laid off from the typing pool had time to like skill up in word processing and or find a new job. Like, I think it'll just come for so many jobs so quickly. You won't even know where to skill up. You know, you'll skill up in another industry and then that'll get automated.
The trick, though, there'll be this sweet spot in the middle where if you can act quickly enough and utilize AI, ChatGPT and all these things before your manager realizes that you're utilizing them, that you could effectively outsource your own job to AI and pretty much just run like maybe a year or two of doing some pretty high quality work. with minimal to no effort. So make hay while the sun shines, would be my advice. We've got more.
Oh, yeah, number 9, just the last one. Last one there is he reckons that democratic capitalism is on the ropes, that there's the rise of populist and authoritarian militaristic extremes.
These guys, did they get the same list? They got the same list, didn't they? And one of them went, well, I'll just say like why all of these things are good. And the other one went, I'll just tell you why they're all bad. And like they've all named the same things, but they've had opposing views about them. Yeah,
well, I mean, we are naming the big themes of the moment. So yeah, Rubini is a bear, so he's taking a bearish view on all of them. Yeah, so he's definitely disagreeing. Number 10 is Shane Oliver's a dickhead. So yeah,
them's fighting words from Dr. Doom. Is Dr. Doom even a real doctor? That's the other question I've got. When did he get his PhD? All right, let's take a moment to digest all the positivity and all the negativity and some kind of come out somewhere in the middle. We'll take a short break here, grab a word from our sponsors and be back with more Comedian versus Economist right after this. Welcome back. You're on Comedian versus Economist. Thank you for joining us again in 2023. If you do like the show, you're enjoying the show, please rate and review it wherever you get your podcasts. That would help us out enormously. Or send us an email if you like, cve@equitymates.com or via the website, equitymates.com/CVE. Thomas, I want to talk about the housing market. Where's the housing market at? Any good news for people wanting to buy a house?
Oh, there really isn't. No, there's no. No, hate to be Dr. Doom, but
right.
Yeah. No, I mean,
thanks for bringing it up. Good inclusion. Excellent choice of topic for this week's show.
Yeah. No, house prices are still falling and look set to continue falling. Housing finance data has come off a pretty significant way, which tends to lead house prices. CoreLogic have a leading indicator based on different activity metrics. That's coming off pretty quickly. So I think we're down about 10% now. People are looking at sort of 15% total. I think that might stretch to sort of 20 depending on how the fixed rate reset happens. So maybe you're doing that, but we're still up well on pre-COVID levels.
So that is good news for people wanting to buy a house if houses are coming down.
Well, it is, but rents are exploding in a pretty crazy way. And I talked with Sasha about this on The Dive this week, so maybe jump over that for the full story.
You should subscribe to The Dive anyway. It's an excellent podcast. Award-winning now, The Dive. So if you haven't tuned in already, find it wherever you get your podcasts.
Yeah, but the rental market is going ballistic. So rents have re-accelerated. They were growing at close to 10% a year through pretty much all of 2022. Started to slow a little bit towards the end of the year, but they've since re-accelerated. Yeah, it's just going crazy hot.
Where did it come from, the rental crisis? Like, was it a COVID thing or was it?
Yeah, so check out The Dive for the full story. But yeah, just quickly, like we had that pick up in average household size. Sorry, a fall in average household size. So we needed more homes for the same number of people.
Yep.
Maybe it's home offices, that kind of story. So yeah, we just had more people than we had houses. We're at a shortage already, but vacancy rates have fallen through the roof. the stat that really blows my mind is that the total number of homes for rent at the moment in Australia is down about 26%, at the lowest levels since February 2003. So there were more homes available for rent in 2003 when the Australian population was like heaps smaller than there are right now.
I mean, it's interesting. I wouldn't call it mind-blowing.
Blows my mind.
It's tidbit. It's something. Yeah. It's barbecue worthy. I'll give you that.
The Daily Mail leaked an email from Meriton Property Management. So they own and lease out a bunch of property. They sent an email to their property managers saying, as you are aware, the market is on fire and vacancy rates are extremely low. So please ensure you're pushing rents as hard as possible.
Oh, what a lovely gesture.
Yeah, isn't that nice? They even recommend signing 6-month leases if possible, so you can jack up rents in 6 months' time when they come up for.
Wow.
Yeah, so
it's great to see people coming together at a time of crisis.
Yeah, hard to know which side is Team Australia really when you look at it.
Right. Well, so is there any hope for renters? I mean, where do they go from here?
New Zealand, maybe.
No, it's flooded.
Oh, yeah. No, I think it's dire times. It's not. It's right. Yeah. It's a tough time to be a renter, and it's we've reopened the borders. They're talking about record immigration inflows this year to try and catch up in quotation marks. So looking at over, Treasurer Chalmers was out the other day saying he expects it to come in over 300,000 this year. Through the 2000s, that it was around 100,000 a year, got jacked up to 180. Now it's 300,000. So it's a huge number. All of those people need homes. Yeah. We're already in a housing crisis. So it's a bit like, it's kind of like, well, where do these people go?
So what is the government not thinking? Like this is pretty serious stuff, right? Like are they not thinking about where these people are going to land and live when they get here, or are they?
I think either they're not, or B, that's kind of how the housing industrial complex works.
Right.
Is you stuff the cities full of people and that pushes up prices. And if you own properties, then hooray.
Hooray.
But I think it really feels to me like we're pushing towards a breaking point. Like vacancy rates in the capital cities are like 0.7%, like just crazy tight. You see the queues outside rental homes at the moment. They're just nuts. And it's going to get worse. Like I think through the rest of the year, it's going to get worse.
Right.
And that hurts. So the rents go up. If you're a first home buyer, you're getting hammered because you're paying more in rent.
Yeah.
Your borrowing costs are going up anyway. So you can't, even if prices are lower, you can't get into the market. You can't get out of renting.
Will we see a reversal then of the housing, whatever you called it, the housing dynamic or structure? And will there be more people sort of rejoining houses?
I think I expect so. But I think if you've got a house, like we're moving from work from home towards hybrid, that seems to be the main thing. So people still need those home offices and those extra rooms. The other dynamic here is that you had this flow to the regions through COVID. That's reversing now. So people are had the big influx into the regional centres. That's now reversing. People are moving back towards the capitals. Right. So you've got an extra flow pushing back to the capitals. So I think the regional markets won't fare as badly. But I think the capital city markets are really going to struggle.
Can business help with this though? Like, can business go, we're not going to force people to come and work in the office 2 days a week, or like if we fully embraced work from home and say, well, you know what, because we're going to abandon hybrid because it's kind of unnecessary given how much people are working from home anyway.
Yeah. I mean, I think they could, but I just that's not going to be in their decision making. It'll be like what's best for the business. And it seems to be the majority of businesses saying like we're okay with some work from home, but we need some work in the office to make it work. So yeah, so I just don't see it reversing anytime soon. But I look at it and it feels like it's pushing towards a breaking point, because if there's just not enough rental properties available, or even like anything in a reasonable price range, then that's starting to tip people who would never be at risk of homelessness, towards sleeping in cars. And once that starts to happen, then you start to get some very angry people.
Yeah.
But there's no easy solutions to it either. There's nothing you can really do to sort of knock it on the head. But
used car prices are coming down, so there's something. Hey. Sorry, I shouldn't make light of that horrific situation. Just, I have very limited economic data in my head, and that was one data point that I had that I thought was relevant to the conversation. All right, Thomas, finally, we got some population data out of China. What did we learn?
Yeah, China's in a bit of trouble, actually. Yeah, things aren't looking that great. So China's population actually fell 2022 versus 2021 for the first time in 61 years. So last time it happened was 1961, which is worth noting. That was in the middle of a famine. Was the last time the population fell. It had the lowest birth rate on record. So we can think about the replacement birth rate as like 2.1 births per couple. So that's for a stable population, you need 2.1 births. But the birth rates in China is down to 1.1, which is way off replacement. And in the big cities where the majority of the population is, it's down to 0.7.
It's not even a whole child.
No.
It's very difficult. Yeah.
So the birth rates tanked. Yeah, and for the first time, there were less than 10 million births for the first time since 1960.
Right. Oh, I guess the big question is why? Why are people not having babies?
So China had the one-child policy for quite a long time, and it got richer. So we know that as countries get richer, people have less kids. The economic opportunity cost of having children goes up. So if you're a subsistence farmer, there's good reasons to have lots of children. But as you move to the cities and get higher paid jobs and things, children are actually expensive. Yeah, and so people just naturally tend to have less children.
No, I didn't realize that.
Yeah. So you look at all the UN population forecasts. They tie in with the economic prospects. So you look at like Africa, for example, currently has very high birth rates. But as the UN expects Africa to become more wealthy, they expect the birth rate to go down. Right. And the population population growth to slow.
Is it also to do with education facilities, birth control, like just planned pregnancies as opposed perhaps to more, just
improvised pregnancies?
Oh, that's the thing. I was going to go with accidental, but improvised.
It's a whole range of factors. We don't, and we don't sort of know what contributes to what exactly, but we just know that those things are correlated. As household income goes up, birth rates go down. Yeah, so those two factors coincided. So China was worried about overpopulation and so introduced the one-child policy, but they were probably going to get, move towards something like that just through getting wealthier. But you have both of those things. And then the one-child policy, is saying that they want the birth rate to be 1. 2.1 as replacement, birth rate should be 1. So it was a mistake. And in hindsight, it was a big mistake. And it's creating these problems. And so, you've got this really low birth rate. You've got a rapid aging in the population. So the Chinese population is aging faster than any population in the world.
What does that mean? What do you mean they're aging faster?
So you look at the mix of the population, and you've got 10% of people are under 5, 10% are under 15 or whatever. The cohort that's over 65 or past retirement age is getting bigger and bigger at a faster rate than any other country on earth.
Right. I thought maybe they just didn't have access to oil of Olay.
Yeah. Yes. They just look old.
Help fight the 7 signs of aging.
While the population in total is falling, that's actually much better than what it's actually going on, because part of the reason why the population hasn't been falling is through increases in longevity. So people are getting older and not as many people are dying, and so that holds the population up. But underneath the surface, what you've got is a shift towards an older population. Right. And then in sort of 10 to 15 years, you've got very few people in your working age cohort looking after lots of old people. And that's a real challenge for your economy.
Yeah, right.
And so this is sort of where China's at, is that they're facing a rapidly aging population, and we don't have an economic model for it. We don't have no country in history has ever seen massive population aging the way what China's facing. It's the fastest aging society in human history. No nation has been able to hold that and continue to grow economically.
So China's heading for like a massive recession?
Yeah, effectively. Like a bit like Japan, I think. Like, Japan's sort of just been going nowhere for decades. I think China's probably facing the same thing. So we're probably, in terms of China's economic power, we're potentially close to the peak.
Right.
There's gains to be made from like changing the mix of the economy towards higher value production. It's going to struggle to grow from here.
Is there a possibility that it becomes more efficient with less people though? Like you kind of don't have to find jobs for everyone. You can kind of utilizing AI, for example, you can start going, well, you know, we actually don't need that many people. And if we have lots of births, then we got to find jobs and homes and everything else for them. So maybe this is a good thing.
It's potentially true, but we're talking about a different model. Like, and this is sort of the key, you know, the Achilles heel of global economics at the moment is that without growth, things start to unravel and we start to create unemployment and
not if you don't have
dramas.
People.
Yeah, true. There could be a way through, but we don't really know what that is. China's going to have to improvise and find their own way through this.
Interesting.
But it's a big challenge.
All right. Well, I'm available for consulting if any Chinese government officials would like to pick my brain on best way through it. Seeing as this is uncharted waters, I feel like everyone's voice should be heard. All right, that brings us to the end of the first show for 2023. Quite a long one, I think, in the end. So hopefully you enjoyed it. We love doing the show. Stoked to be back talking to you again. Yeah, in fact, we'd love to hear what you think. Equity Mates has launched the community survey, which helps us to understand who's engaging with Equity Mates Media across not just this podcast, but all of the podcasts from Equity Mates. It assists in commercial packages and, more importantly, how we can continue to improve our content to help the audience on your money and your investing journey. So there's a link obviously on the Equity Mates website. We'll also post a link in our link tree off our Instagram. There are 2 prize pools for community members who will be automatically entered if they submit answers to all questions and provide their email address. So the first prize pool, Thomas, is $500 cash, cold hard cash. The second prize is 3 tickets to FinFest 2023. Yes, that's right, 2023. We're doing it again. If you were at FinFest last time, you know how much fun it was. So get your submissions in. Closes 28th of February. Shouldn't take more than about 10 minutes to complete. So if it does, you're probably doing it wrong. Or maybe you just like to really give these things a lot of thought, which we also appreciate. And speaking of FinFest 2023, early bird registrations are in fact now live. So FinFest is locked in again, November the 11th, 2023 at the Carriage Works in Sydney. Ticket information, speakers, etc. will be announced later on. So head over to equitymates.com or head over to our Instagram page, CVE Podcast, and you'll find the links to both of those things there. So that does it for this week. Thank you so much for tuning in. Big thank you to Sasha for her work on the new intro and everything else that she does every week for this show. Much appreciated. And we look forward to talking to you again next week. Bye for now.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.